Hey, this is Matt from InvestiQuant. Today is Monday, December 21st, 2020. And this morning, the markets are trading down sizably to start the week. We've got a huge range in the overnight session. We're trading below Friday's low, which was a pretty wide range as it was. That closed up near the high. So we have taken back all of that last part of the day rally that took place on Friday, and we have pushed quite a bit below Friday's low beyond that. So we currently have 128 points of range in the overnight session. This is about what you get in a normal week's range. We've got that just in the overnight session. So a lot of activity taking place, and we are getting some sizable down gaps this morning as we approach the open. So what I want to do today is take a look at what has happened historically when you get a giant down gap in a bullish environment like we have been seeing. We're pretty much coming off of all-time highs. So we're going to be looking at all four instruments. The setup is going to be based upon entering the market long at 9:30 a.m. Eastern Time, exiting at the close, which is 4:15 p.m. Eastern Time. Now, to define this opening location, we've got all kinds of different ways you can do it, from technical areas to gap sizes to pivots. I mean, about anything you can think of. But for this one, what I'm going to do is I'm going to say it's a gap down of at least 100% of the 5-day ATR. So you're getting a gap size that is at least as big as what you've been getting for basically the entire day's range in a normal session. So just for reference, the 5-day ATR in the S&P right now is about 37 points. So our gap right now is going to be quite a bit larger than that, assuming we don't change too much from where we're at right now. And then next, I'm going to go into the indicator section. I'm going to put us in a bull market environment above a 10 and above a 200-day simple moving average, and then click View Results. All right, here we go. So these are the results of going long at 9:30 a.m. Eastern Time, exiting at the close, which is 4:15 p.m. Eastern Time. When you are in a bullish market environment, which I've defined as above a 10 and above a 200-day simple moving average, and you get a gap down of at least 100% of the 5-day ATR, so a sizable down gap in a bullish environment. Historically, we've got 33 samples in the S&P, 31 in the NASDAQ, 35 in the Dow, and only 12 in the Russell. So not happening very often there in the Russell. The others, quite a bit more samples compared to the Russell. And if we take a look at the win rates on them, the three that have the most win rates here, or the three that have the most samples of, just over 30, you've got the S&P coming in at 61% win rate. That means 61% of these are closing above the opening print. Almost identical here in the NASDAQ, 61%. The Dow, 54%. So those three are leaning a little bit more towards the long side. The Russell, just 12 samples, dead even, 50-50 on that one. If we take a look at the average win to average loss, you'll notice the average loss is sizably larger in these. So you've got the average loss more than twice the size of the average win here in the S&P. The average loss quite a bit larger than the average win in the NASDAQ. That is also true for the Dow. And then in the Russell, the average loss is also larger than the average win. So all four of the instruments do have larger average losses compared to their average win size. And then three of the four instruments are leaning a little bit more towards a winning session, which would be defined as closing above the open for that day. So they've won a little bit more frequently than they've lost, but when they've lost big historically with this pattern. So hopefully you found that helpful. Good luck today, and we will see you next time.